Ladies and gentlemen, welcome back to the channel. We have big news to cover today. JP Morgan says the Fed next week is going to end quantitative tightening. Now, if you don't know what quantitative tightening is, well, quantitative easing is the practice of buying assets on the open market to drive down interest rates, drive down treasury yields, maybe provide stability in these markets. Well, the exact opposite is true of quantitative tightening. Quantitative tightening is the practice of selling the assets they once bought on the open market. This helps to keep treasury yields higher. Not good things. Well, at least for the stock market. The stock market tends to react very positively to quantitative easing or the end of QT. So this could be a big catalyst coming next week. But before we get to next week, we have CPI. CPI is really the first set of BLS data we're going to get since the government is shut down. I have my own opinion on what CPI could look like. We're going to be going over the CPI estimates from major banks, what JP Morgan says the markets could do if we get CPI numbers in certain ranges. But really, I'm going to give you my thoughts as well. I think CPI is going to come in really good. Why in the world would Trump put out the CPI report if it wasn't going to be good? Okay, that to me would make no sense. You think Trump isn't in tune with what the markets like or don't like? He is. He knows damn well the CPI report is going to look good tomorrow. In other words, I would be shocked if we get a bad CPI report tomorrow. It would really make me question Trump's whole game plan here. Okay. So we're going to talk about it. We're going to talk about my expectations, where I think the CPI numbers are going to come in, and how this could impact markets. Now, we're also going to look at some of the breaking news today because there's quite a bit of it. One thing I will say right from the start is oil is up over 5% today because the Treasury initiated sanctions on both of Russia's two largest oil producers. Well, this is something I didn't see coming. China actually says that they're going to follow those sanctions, that they're not going to buy Russian oil. Okay, or at least those are some of the preliminary reports that we are seeing. This could be fueling some of the resurgence in the risk on move today. China and the US seem to be, I guess, getting along a little bit better. And that's got to be good for trade negotiations, you would think. So we have a lot to cover in today's episode. Hit the like button as well as subscribe to the channel if you have not done so already. Check that link out down below in the description of today's episode if you want to come invest with the best trading group the world has ever seen. What we are doing is unlike what anyone else is doing. We're not necessarily chasing the highest flyers, okay? We're trying to find those before they are the high flyers. Okay, we're trying to invest in the stocks that Wall Street and retail are overlooking. And I mean, when I tell you I invested in Novartis Semiconductors, stock $17 today, I invested in that at less than $2 a share. Applied Digital, I bought that stock at $3 a share. Today it's over 30. I bought Nebius in the 20s. Today it's well over 100. Okay, I bought Palantir on IPO day at $10. I thought Wall Street was overlooking the potential of Palantir back in the day. Okay, lots of examples of this. But that is the strategy that we are doing. If you guys want to come join it, check it out, link down below. If not, well, let's get into today's episode. Now let's take a look at what's happening in the broader markets today. You are seeing the Russell 2000 outperforming for the first time in a while, okay? Normally, like recently, every day the Russell has been underperforming. Risk on has been selling off. Well, today the Russell is up 0.80%, so that's a really good sign for a lot of our portfolios. The NASDAQ is up 0.53%, S&P is up 0.32%, and the Dow is up 0.09%. The VIX down 2.58%. So that's also good to see. 10-year Treasury yields are sitting at 3.982%. They are up about 3 basis points today. Oil is up 5% following the Trump administration that put sanctions on big Russian oil companies, okay? The Treasury Department said it was doing so because of Russia's lack of serious commitment to ending the war in Ukraine. They say, quote, "Now is the time to stop the killing and for an immediate ceasefire," Scott Bessent said as he announced the sanctions on Rosneft and Lukoil. Quote, "Treasury is prepared to take further action if necessary to support President Trump's effort to end yet another war," Bessent said. "We encourage our allies to join us in and adhere to these sanctions." So oil's going up a little bit today. It's still at a very low level. I think some of Wall Street was getting a little bit nervous because oil was so low. That's really a sign the economy is not doing great. So in a weird way, oil going up today is maybe a comfort to some people. Now, gold. Gold is up 2.35% after seeing its massive liquidation in the past couple of days. I think that looks good to people as well. Same with silver. Silver's up about 3% today. Gold and silver just basically liquidated for no clear reason. Okay. And I think this did spook some people because, again, gold and silver don't drop 6% for no reason. Now, keep in mind, the gold and silver markets are the most manipulated markets in the world. Okay. Heavily manipulated. So weird crap can happen, but I don't think it's necessarily has been a sign that things are wrong in America. I see the economy lately as kind of unchanged. Like not a lot is changing. Okay, come on. Do you want more bites? Now, also in the news today, sales of previously owned homes rose 1.5% in September from August to a seasonally adjusted annualized rate of 4.06 million units, according to the National Association of Realtors. This is slightly less than the analysts were forecasting, but the highest pace in 7 months. Now, we also had earnings from American Airlines today in pre-market. Honeywell, Dow, Hasbro, Nokia, Southwest, AutoNation, and T-Mobile. One of them that stands out was American Airlines, that they actually did very well. Now, that's a good sign for travel. You know, that's one of the things people are going to cut back on if the economy is not doing well. So another strong sign that this economy is holding in there. Today in after hours, we are going to have earnings from Intel, Newmont, Alaska Airlines, Deckers, Boyd, Ford, and some others. Now, this looks like a really good headline. Chinese state oil majors suspended seaborne Russian oil purchases due to concerns about Western sanctions, per the Wall Street Journal. So even China complying with U.S. sanctions on Russia? That seems like a positive headline to me. The White House confirms that Trump's 3 p.m. announcement will be on cartels. Mexican President Sheinbaum says, quote, "We do not agree," when asked about U.S. attacks on alleged drug-running boats. House Minority Leader Jeffries on a long-term stopgap possibility says, quote, "It's unacceptable." China has been building large oil reserves for months, insulating itself from possible U.S. sanctions on Russian crude, per Reuters. House Minority Leader Jeffries says Trump should sit down with Democrats before his Asia trip. House Minority Leader Jeffries says Trump is not giving GOP leaders permission to negotiate. Jeffries says conversations with Republicans have been limited. JP Morgan says that the Fed will end quantitative tightening next week. Now, quantitative tightening is the practice of selling assets off of their balance sheet. Okay, quantitative easing is buying assets from their balance sheet. So stocks tend to react very well when quantitative tightening stops or when quantitative easing starts. Okay, and I don't think we're going to have QE anytime soon. I don't think the Fed's going to be necessarily buying bonds or buying mortgage-backed securities or buying corporate bonds anytime soon, as long as there's not some kind of, big crisis on our hands. But to stop selling assets off of their balance sheet could be a big positive for stocks into the end of this year. So that could be a big announcement next week. Now, the markets are eyeing September CPI and volatility that is likely. U.S. September CPI data drops Friday at 8:30 a.m. with expectations. Headline CPI up 0.4% month over month, 2.9% year over year. Core CPI up 0.3% month over month and 3.1% year over year, excluding food and energy. JP Morgan outlines how the S&P 500 could react. If core is 0.25 to 0.3, you could see a 0.75 to 1.25% gain. They call that a 25% chance. If CPI is 0.3 to 0.35%, the S&P will be flat to up 0.5%. They call that a 35% chance. If CPI is 0.35 to 0.4 month over month for core, you're going to be down 0.5% to down 1.25%. If CPI is over 0.4% month over month, you're going to be down 1.5 to 2.25%. They give that a 5% chance. And if CPI is lower than 0.25, they say the markets are going to be up 1 to 1.5%. They also give that a 5% chance. Now, quantum computing stocks jumped today after a report says that the Trump administration is in talks to take stakes in firms. You had IONQ, Rigetti, D-Wave, and quantum computing all up over 10%. Supermicro released Q1 preliminary sales that missed expectations. Q1 net sales at $5 billion versus the estimate of $6.49 billion. Revenue shift, some expected sales pushed to Q2 2026 due to design win upgrades. Product demand, they say, is strong for Blackwell Ultra, and shares were down about 8% this morning. U.S. Trade Representative Greer on China trade says it makes sense to talk, but we'll see. China's Vice Commerce Minister says we welcome U.S. retailers to operate in China. The Kansas Fed Composite Index today came in at 6, the forecast was 5, and the Manufacturing Index for the Kansas Fed District came in at 15, the estimate was 6. So better than expected data out of the Kansas Fed region. Okay, so shout out to Nick Timmerhouse for this one. He always puts out the estimates from major banks. So you can see it on screen here. Bank of America, and we're really only going to focus on core because that's what's really going to move markets. So the lowest estimate for core is from Employ America at 0.25%. They don't have a year-over-year estimate. Well, actually, Moody's has the lowest estimate here at 0.22%. month over month for core. That would be an incredible number. Now, year over year, the lowest estimate is 3.0% from First Trust as well as Moody's. Okay, most of the year over year estimates are around 3.1%. That's the median forecast. That's where most of these estimates are. Bank of America at 0.25% month over month. Barclays with a high estimate of 0.36%. BMO Capital Markets 0.32%. PNB Paribas 0.32%. Citadel Securities at 0.32%. Citigroup at 0.28%. Deutsche Bank at 0.32%. Employ America again 0.25%. First Trust 0.3%. Goldman Sachs 0.25%. JP Morgan 0.3%. Again, Moody's at 0.22%, Morgan Stanley at 0.32%, Nomura at 0.35%, Pantheon Macroeconomics at 0.3%, TD Securities 0.30%, UBS at 0.27%, and Wells Fargo at 0.27%. So believe it or not, the estimates are kind of all over the place for this. There's not a lot of consensus on where these numbers are going to come in at. Now, the median forecast is 0.3%. But again, the low estimate, 0.22%. The high estimate, 0.36%. That's, that's a wide swing Okay. Now, last month was 0.35%. So really, as long as we're below 0.35%, I don't think you're going to have a large negative reaction. Okay. Well, let's be honest with each other for just a moment. Okay. Whether you like Trump or not, Trump did not put out the jobs report. He has not put out initial jobless claims. He can. He said he can. He literally said he can put out the data if he wants to. Okay. Retail sales has not come out. You name it. Like GDP numbers have not come out. You get the idea. But they're going to put out the CPI report. Come on. Let's think logically on this. I don't have to break down the numbers of estimates of different categories of CPI to understand that I don't think Trump would put out a bad number. It's not going to make him look good. Yeah, okay. Now, I guess a bear could say maybe he's going to put out a bad CPI report to show the Democrats having the government shut down is hurting the economy. Maybe, but you know, I see it more as Trump wants to put out good numbers. Okay. I don't think Trump wants to put out a bad number. This CPI report does not have to come out. Okay. This was Trump's doing. Okay. They say it's coming out because of the annual seasonal adjustment for Social Security, but don't buy that for a second. Okay. Maybe I have a tinfoil hat on here, but I think it's quite logical, right? Trump doesn't do anything for no reason. So I think we're going to come in with a really low print. Okay. Remember back in the day, I believe it was like a year ago, maybe 2 years ago, where we got that really like surprisingly good CPI report and the Russell was up 7% the next day later. Maybe you guys can find that for us. Maybe I could find it just by looking at the Russell. But yeah, the Russell was up like 7% the next day later on the way better than expected CPI report. Like it was a blowout CPI report. I don't remember. Yeah, it doesn't look like I can find it just from looking at the charts. But it was up like 7%. Okay. Oh, maybe it was here. No, it does look like a gap up from hell though. November 6th. No, that was when Trump got elected. You get the idea though, right? You could see something quite incredible tomorrow if the CPI report comes out because it's just a really good report and Trump wants to put that out there. Okay. You could see a number like 0.15%, something half the estimate. You could see year over year core at, let's say, 2.9%. What's that going to do? It's really going to prompt the Fed to cut rates, maybe a lot more aggressively than we're even pricing in now. Maybe that could justify a 50 basis point cut. Now, it's getting a little ahead of ourselves. Probably not, but it does justify a series of rate cuts from the Fed. Now, here's the paradox from this. Let's say the CPI report comes in at 0.1% month over month. Let's say, you know, there's just really no inflation, like some categories of the CPI report are really bad. That begs the question, what's happening with the economy? Now, I suggested, I believe it was on Tuesday, that the CPI report may have been leaked. The reason I said that is because gold and silver sold off something crazy. Okay. Gold was down like 6%. Silver was down like 5.5%. Now, you've seen quite a rally in gold and silver, but gold and silver are seen as really inflation hedges. Okay. Why did they fall 6% for no reason? Could it be because Wall Street got leaked the CPI report? If inflation is no longer going to be the problem that a lot of people on Wall Street have grown to believe it is, a longer term kind of problem, wouldn't that make sense why gold and silver was down 6% 2 days ago? It would. Now, you've also seen stocks come under pressure with what could be a really low CPI report, a really good number. That could send some warning signals for the economy. See, inflation cannot thrive in a strong economy. Okay, I said that wrong. Inflation cannot thrive in a weak economy, okay? Because inflation is the practice of raising prices, okay? If people are losing their jobs, if the economy is bad, people will not pay the higher prices, okay? If you are a company, you would rather sell products at lower prices and take a lower margin than get beat out by the next guy that doesn't need to raise prices. It would be like take Coca-Cola and Pepsi for an example, right? If Coca-Cola overnight raised prices to $2, let's say, for a Coke at a gas station, okay? Well, great, whatever, tariffs, whatever the reason is, they're raising prices, fine. Some people are still going to buy Coke, loyalist, but it's called demand destruction, okay? What if Pepsi keeps their prices at $1.50? Pepsi's going to take a lot more business. Now, if the economy is so strong that everyone's raising prices, Coke raises prices, and Pepsi goes, well, we can raise prices too, okay? Because the economy is so strong. People are just going to pay the higher prices, okay? They both raise prices. They're both net where they were before. But if you start to get companies raising prices and others not, that's a problem, right? If the economy is weaker and people will not pay higher prices, if people will just say, okay, I'm not going to buy Coke or Pepsi if they both raise their prices, right? I'm trying to come up with a very simplistic example to show you guys this, but not all companies are going to raise prices, okay? If the economy is weak, there's going to be some companies that can undercut others and take market share, right? Companies don't want that. So in a weak economy, inflation cannot thrive. Can there be inflation in certain areas? Sure. But inflation broadly cannot thrive. So if we get a really low CPI report tomorrow, that's not a great sign for the economy. That's really good for Fed rate cuts, blah, blah, blah. And there is positives there, but it's not a great sign for the economy. So really, in all reality, you probably want a CPI number in the perfect ideal situation around 0.15%. Okay, 0.15% times 12 on an annualized basis is 1.8% inflation. That's a really good number. It's not so low that you have to be concerned about growth, but it's not, it's running slightly below 2% on a 12-month annualized basis. That's about as perfect of a number as you could get. Maybe 0.17% would be picture perfect. That would put CPI at about 2.04% on a 12-month annualized basis. Okay, that would cause stocks to explode. But let's say we get a 0.07% number. Times that by 12, you're looking at less than 1% CPI on a 12-month basis. That may be looked at as, oh crap, what's happening in the economy? Okay, so too low could be a problem. Too high is obviously a problem. But that sweet spot, that best case scenario is between 0.15 and 0.2%. That would beat Wall Street's estimates at 0.2% by over 30%. So, but it would still show the economy has a little bit of inflation, which is, good, I guess, since we're not getting economic data and we don't know where the economy is. Okay, so in my view, you probably come in between 0.15 and 0.2%. I don't think Trump wants to put out a bad number here. I think Trump wants to put out a good number when he doesn't have to release this data at all. I would be shocked if it comes in like high, like a bad number. Okay. Now, what do I think would happen to markets if we do get my expectation, 0.15 to 0.2%? Kind of hard to tell but I do think you would see a resurgence in your risk areas. Okay. You could see the Russell up 2% to 5%. I wouldn't be shocked by that. Okay. Just connecting the dots here. Now, if we do get a bad number, then I think that does give some downside to stocks, but it does validate that the economy is probably doing quite well, right? So even in more of a worst case scenario, I don't see that much downside for stocks. Okay. Could the Russell fall 1% to 2%? Sure. Are you going to have a 5% down day tomorrow? I don't think so. So I think the risk reward is favored to the upside no matter what happens here. But again, I don't know exactly how the numbers are going to come out. But if I were to have to bet black and white, red or black, I'm going to say we're going to have a good CPI report. That's what I would say. That's where I would bet my money. If I had to die on a hill, it would be on a good CPI report tomorrow versus a bad one. But again, the estimates are kind of all over the place, and even meeting expectations might be seen as a good thing, right? You have Morgan Stanley that is higher than the median estimate. Namara that's higher than the median estimate. You have Deutsche Bank higher than the median estimate. Citadel Securities higher than the median estimate. PNB Paribas higher than the median estimate. BMO Capital Markets higher than the median estimate. And Barclays substantially higher than the median estimate. Really, Bank of America, Citigroup, Employ America, Goldman Sachs, Moody's, UBS, and Wells Fargo are the only banks that are actually below the median estimate. So again, estimates are all over the place, but they do seem skewed higher than 0.3%. Okay. So even meeting expectations could be a really good number for markets. Now, the headline number, again, is all over the place as well. The lowest estimate for the headline number is 0.32% from Bank of America. The highest estimate here is from Citibank is at 0.49%. So, like, none of these banks really know anything. Their estimates are all over the place. So, yeah, if I were to have to bet on what the outcome is going to look like from the CPI report tomorrow, I would bet we're going to have a positive reaction. That's how I'm positioned in my portfolio. I don't have any hedges on. I'm not, nervous about tomorrow in that regard. Even keep in mind, even if we did get a relatively bad number, a number that comes in slightly hotter than the median forecast, you've already seen risk assets sell off, right? You've already seen a lot of some of the stocks we even talk about on this channel down 30% the last month. Like, that is not uncommon. So you've already kind of priced in what could be a bad CPI report, which I think from a risk, perspective, a lot of hedge funds and institutions recently have been forced to sell because risk has risen, the VIX has risen, and you have event catalyst risk, right? I think it's almost, you've seen a sell the rumor situation in a lot of areas of this market. They've been selling the rumor of bad CPI, and they might actually buy the news on a good CPI report or an inline CPI report. Could have a very risk on direction or tilt to stocks. So yeah, those are my thoughts. Let me know your thoughts down below in the comments section. I view it, though, as a much greater odds of a risk-on move tomorrow, of stocks actually doing well versus doing poorly from the CPI. So that is going to do it, ladies and gentlemen. Come join the trading community if you would like to. Link down below in the description of today's episode. As well as that, get yourself $100 in free stock when you sign up with the link down below with Public. Deposit $1,000 and they will give you $100 of free stock in your choice. So yeah, that is it. Have a great rest of your day, and I will see you in the next one.